All right, so when you start out investing in any of these investors, Ryan Cohen is a very good investor, so for argument's sake, I'm putting him as good as Peter Thiel, as good as Sequoia, as good as Steve Cohen. And at the start of the investment, you put in $100,000, $100, doesn't matter how many zeros you add here. You could add 1, 2, 3, 4, 5 zeros. And you're hoping all of these managers are going to make you money, right? You never go in there thinking otherwise. But once you buy a share of GameStop, you put in the cash, your stock represents you basically marked up your cash to 287. So the book value of the company, another way to look at it, is $33. So you paid $100 for $33. But with Founders Fund, when you give them $100 on 920, it's worth $100 on 921. They haven't made any investments yet, right? Same thing with Sequoia, same thing with 0.72. Let's fast forward a month, okay? A month passes. The money in GameStop is still worth $33. Why? Look at the balance sheet. $100 of GameStop. There's no other business, right? We know that we agree the GameStop business is worth nothing. But even if we could argue the GameStop business is worth $1 billion. Okay, so we got $4 billion in cash, $1 billion for GameStop, $23 million in debt, $5 billion. Well, per share, or divided by the market cap, that's 43 cents on the dollar. So I'm going to say GameStop, the business, is worth a little bit. So I'm going to add that. So you paid $100 for 43 cents worth of assets. But you're doing it because Ryan Cohen's such a good investor. Agreed. He is very good. He's extremely smart. But Founders Fund is also very smart. Sequoia is very smart. 0.72 is very smart. There's a lot of smart investors out there. And even though, as good as Steve Cohen is as an investor, or as good as Sequoia is as investors, Pershing Square, sure, even Warren Buffett, I'm not going to buy a share in 0.72's fund for twice the value that's in the fund. It's never heard of. People do all kinds of hedge fund investments, all kinds of private equity. You can put KKR fund here. You can put, you name it. Even Renaissance. Any VC, we'll pick hedge here. This is PE, a buyout fund, quant fund. It's all the same. Now, after a month, at Founders Fund, they've made private investments, right? So maybe they bought a share of Anduril. Maybe they bought a share of SpaceX. Maybe they bought a share of OpenAI. And it's privately held stock, so you don't really know what it's worth. But let's say they say, they give you a monthly report, something like that, and they say the value of our fund is 101. Okay. Sequoia is very similar. In fact, we can kind of remove Sequoia from here, and we can just say VC, Founders Fund, Sequoia, Lightspeed, you name it, General Catalyst, all the VC firms. And we can do the same thing with hedge funds. Let's say 0.72, we could say Millennium, we could say Citadel, etc. And the same thing with private equity, KKR, Carlyle, Blackstone, and Renaissance is just a hedge fund, right? Okay. The hedge funds give you a report and they say they made 3% in the month. All right? Good month for the hedge funds. Well, the private equity guys, they say, we bought a bunch of companies, but we're not going to mark them up. Okay. Let's say a year passes. Now the VC says, well, we haven't exited anything from our portfolio, but we have reason to believe that we're up 10%. The hedge fund said, we had a great year. We're up 15%. And the PE firm says sort of the same thing as the VC. We don't know what we're worth yet, but that's that. If you look at the balance sheet, GameStop has the cash increased what is the book value of the assets? Well, it's the same thing. We know that, let's go to GameStop. We know the cash is $4 billion. We know the debt's 23. After a year of operations, what has happened? Is GameStop the business worth anything more than it was worth last year? Probably not. It's kind of this stagnant business that is sort of run on a break-even basis. Break-even's better than losses. Let's take a look at the income statement. It's been kind of break-even. So a business that doesn't make any money, in fact, it's been losing money chronically. So I'm being generous in saying it's worth $1 billion, right? I'm being very generous. But basically, nothing's changed, right? Unless Ryan Cohen makes an acquisition. But hold on, all these other guys are trying to make acquisitions too. And a lot of them are doing it. But for argument's sake, Ryan Cohen doesn't make an acquisition by 9/20/25. Okay? So you've got $33 a share in cash, $10 for GameStop, and now you're at 43. All right, let's say another year passes. And this is a much more interesting year. The PE firm says we made 15%. The hedge fund says we made another 10%. The VC says we made 25%. One of our startups went public. Okay. Now again, Ryan Cohen says, I made a deal too. I bought a company. And let's say, again, here's the GameStop situation. I'll just put it down here so it's easier to see. There's 427 million shares outstanding. There's, I guess we could do it like this. In cash, there's $4 billion of cash. Let's just say 4,100. So this $9 share of cash. Maybe one way to look at it is, let's do market cap. Stock's at 25 now. So yeah, so there's $4 billion in cash. This is the value of GameStop. And let's say the new acquisition, right? So you have to spend cash to do the acquisition. So here's the 9/20/25 picture, and here's the 9/20/26 picture. So the shares outstanding, we assume, doesn't change. We don't know what the stock price will do, so we're just kind of looking at book value. But the cash, let's say, goes down to $3 billion because he spends $1 billion to buy a company. The base GameStop business is still worth $1 billion, which again is kind of being generous. But this new co, which we didn't have before, let's say he did an amazing job. It's now worth $2 billion. Overnight, he bought a company for $1 billion, and he got such a good steal that it's worth $2 billion. Like the PE companies are trying to do. The thousands of PE companies that are trying to do this, that are very, very good at what they do, but he's even better. Cool. So now you've got $6 billion of assets. So over the market cap, we're now at 56 cents on the dollar. So which would you rather be in? Another year passes. Private equity funds chugging along, made a safe 10%. Hedge fund a little riskier, made a 15%. Crazy VC, 20%. And remember, you can just buy the S&P too, right? S&P, let's say, makes you 6% after tax. It's 2027. Same share price. Another acquisition. Paid $1 billion. GameStop's still worth $1 billion. The new co did great. It had another good year. It's worth $2.5 billion. So what he paid for $1 billion is now up even more. But Newco 2, this is huge. He paid $1 billion and it's worth $5 billion. Eat your heart out, Carlyle. Eat your heart out, KKR. Right? So what's the total value of the company now? Well, we're at 98 cents on the dollar, thanks to the miracle acquisition. Amazing deal. But we're still far behind any other asset we could have paid for, because why would you pay? You're starting, it's like tortoise and hare. You're starting off at this low point. Right? Look at the chart of it. You're asking yourself to hit yourself in the foot, and you're hoping that you're going to catch up. Does that make sense to you guys? The $43 is the book value of the company plus the value of its assets. GameStop has $4 billion in cash, right? You're paying $12 billion for it at $28, which many people did. And the only other thing they have inside GameStop other than the cash is GameStop, the company. That company's only worth like $1 billion at most. At most. So all the assets of GameStop in total are worth $5 billion. 4 for the cash, 1 for the value. No, the market cap wouldn't be going up because the market cap is a function of the assets of the company. No other company trades publicly at huge premium to their assets because, for fun, they trade at a huge premium to the assets sometimes if the management's good. But yeah, the legacy business is not worth very much. So you're talking about buying something at 41 cents. You're buying a dollar. You're buying 41 cents for a dollar. Well, it's easy. The cash is just the cash on the balance sheet, so that's easy to value. The $1 billion, I'm just putting an artificially inflated number. And these acquisitions are also fictitious, but they represent kind of a best case scenario. He bought a company for $1 billion in my fictitious scenario. 2 years later, it's worth $2.5 billion. He bought another company for $1 billion. A year later, it's worth $5 billion. Very few people can do this. But you're still now just getting to that $12 billion price tag that you paid. The company finally has, after 3 years, the value to substantiate the price you paid for it 3 years ago. While these other guys, you paid them $100 and they turned the $100 into more than $100. You could have done this too with S&P 500. And you don't have to worry about this missing value that hopefully he's going to show up with. He's good, but is he that good? I mean, these guys are good too. You're good. Why aren't you investing in yourself? You should be the manager. Now, if I could get a Ryan Cohen SPAC or fund, I would invest in that for 2 and 20. Yeah, Jay Powers, it's the musical chairs is not logical. Crowds are in recessions and depressions, crowds like that will dissipate very quickly. Yeah, greater fool theory never really works out in the long run, in my opinion. Anyway, a little bit of a diversion there. Lots of diversions, actually. Philip Morris is interesting.